Ready? Yeah, we are. I'm a bear, and this is my strange addiction to shorting strong markets. Over the last few weeks, despite Rader telling me not to short, I continue to short every single green candle. While they see increasing credit card debt and homelessness, I see myself as a visionary. And the collapse of the global economy will give me 300% on my put. I'm sorry. I believe one day Rader will see my vision and the market's dropping. My dad, Rader, one of his biggest concerns is I struggle to get a girlfriend. I used to have one, but she said I was too short. But I'm 6'1". Maybe she was tired. My son struggles to get a girlfriend. He's a huge financial burden. And it's sad to say, but I don't think he's my son anymore. He's just a little bit. You know, I swear the bears were just talking about how the market was crashing. Yet here we are today with SPY closing at 520. And oh boy, do I have some trade ideas for you guys today. My name is Rader. I'm an options and equity trader. And today we're going to be answering the question of how did we get to where we are and what trade ideas can we take so you and I can make some money. First thing you and I have to do is we have to look at the major indice charts. And first on our list is SPY. Well, there's not much going on with the SPY right now. I think majority of trades have exhausted itself, majority of opportunities in it, as we have exceeded the expected range. What does that mean? Well, at the start of every week, there is an expected range that is put forth on the market by the market. It basically rates itself. It says, hey, this is where I think we'll close in between. This helps the market makers make liquidity for the markets, right? If they have no idea where the market's going to close, it makes it kind of tough for them to accurately hedge and provide liquidity for the markets. So because we've extended past that range, I think that there's not much more opportunity in this for the week. However, we are getting close to this 520.50 market maker hedge range. What is it? The blue line, it's just a major liquidity level. I believe that we are going to reject off of this tomorrow into Friday, and we should see a close under 517.60. Any weakness tomorrow, expect a close under 517.60 to come back into that expected range. That is where markets like to close if they stay near it by the end of the week. If they can close there, they will, and that's where the bias is going. And looking at the Qs are incredibly weak. QQQ, technology, everything in the Qs is weak. And this is because technology is lagging. They are the trend laggers. They have been the weaker name. Firms just want defensive names right now, and we'll get to that in a second, but they do not like this idea of high growth, big mega caps. They're rotating out of all of these. They do not like it. So if there is a shorting opportunity tomorrow, find a technology name to short. Don't just go and necessarily short, your favorite name or whatever. Go find a technology name. These will be the bigger movers to the downside. Next, the Dow Jones. This is a definite favorite of the rotations right now. The big pump today, exceeding all expectations, even the market maker hedge range, which just basically means that the market makers were just completely wrong this week. And that's very, very rare. But why is the Dow Jones pumping? It's because the markets and the rotations, when I say the rotations, I mean firms, they prefer the dividend trade. They want to own stocks right now that pay a dividend because they want some sort of security, but they also want to own an asset. And you can see they're rotating heavy out of bonds. They don't give a crap about bonds right now. They want to own assets, and they want stuff that pays dividends. And they are going into the Dow Jones, so expect continued strength across the industrials. I have a trade right now in HD or Home Depot. Expect continued strength to the upside. And finally, the IWM or Russell. Small caps and mid caps, again, have been a favorite of our trading over the last few weeks, and we believe these will do the best over the next few months comparative to the overall markets. Small mid caps have been resilient, and whenever the VIX spikes, I typically like to trade IWM for the cheaper premium, as well as IWM has typically remained more resilient on the drops. It drops less and pumps more than the SPY with cheaper premium. So if there is a major drop in the markets and we do get another long opportunity, expect IWM to be the better name to long. But as of now, SPY or IWM works for just the same trade. So now that we know what happened, what's going to happen? Well, revisiting the SPY chart here, there's one major thing we talked about last time, which was the seasonal expectations. Although we are pumping, I actually believe we are going to see some sort of decline. No, it is not going to break the low, but I do believe there will be a wave of weakness. And this is shown on the seasonal chart. Right here shows the price action tendencies of the markets during certain trading days throughout the month. And we are at this point right here where we see a pump and then an instant turnaround. What does that mean? It means we can expect a fake out. And how do fake outs most of the time happen in the overall markets? A catalyst. So I believe that we are going to get some sort of negative news either this weekend after Friday, after the 10th, or we will see CPI, a big drop into that or after. That's what I think can turn the markets around to see some more wave of selling. But this chart ultimately is just a reminder that you guys need to have downside opportunities, which I am going to provide to you today, and not just go balls deep. So what are those trade ideas? First, let's look at option flow and what the flow team found for this week. There was two major trades that we found. One of them is Chewy. Now, one of the biggest trends on the option flow right now, one of the things we see the most are hedge trades. These are the golden opportunities that we're seeing right now across the option flow. Hedge trades are basically a trade we scan for, an order that comes in. It's a criteria we find, and this specific order suggests that a firm is hedging an underlying position. And when we see that, we can actually bet against it, because if you're hedging one direction, you think the stock's going to move, which means we have the right timing, but we believe they are wrong in direction because they're simply hedging a bigger position. So this right here, Chewy, this is a hedge to the downside. It was a 14.5 puts, and you can see how many contracts he loaded up on that. It's only 150K, but this is what moves stocks right here. They don't want to pay out 7,000 contracts by dropping this even more. So what do? They force it against it. So we did take this trade long. We are still in it, and I do expect continued upside into next week for Chewy. I'll continue to hunt and scan down these flow trade opportunities for you guys and let you guys know when I find some, especially in the Rader Report where I post all of them. Now, also this win trade right here. This win idea was basically we wanted to wait for earnings. If they had a negative earnings, we were going to play the bounce. This is a classic discount trade order, which means that we believe the direction of this order is correct, but the timing is wrong. So we're going to grab it at a discount. And so once win dropped and came back up, it's now chopping at the highs. This is what I call a slingshot setup. It's where you have a chop, a liquidation down, and then you have a chop back at the high. This looks like a slingshot, and what it does is give more momentum for a break to the upside. So as long as these markets hold these upper levels, you can expect this win to break out and do pretty well. So good job, flow team. And now we get to the other trade ideas. I currently am short Amazon. Now this is one of those short ideas that I think is going to play out very nicely, but I am experiencing some pain right now. I'm down around 35%, but Amazon has been incredibly weak relative to the overall markets. It seems it's only being held up by the strength in the overall markets, and that any weakness that comes in, they're going to flush this thing. I mean, just look at the close today. It was a weak close. Even in the morning, there was a very sharp spike down in a weak opening candle relative to the SPY, which had a strong opening drive. Whenever you see a stock that's almost trying not to be strong, that is a good indication that it's going to be the better short when the markets do turn around. We call these laggers. And the key idea for this, if you are not in this trade, is 186.78 is going to be your entry. This is the liquidity zone, and you can expect if we do get back down to there and see a gap down through that, it is going to flush. My targets to the downside are 182.37, and also below that, if things really get spicy, 178 by the 7th. Now the next idea I have is actually on Square. This thing got slaughtered after its earnings, but since then it hasn't really recovered, even though the market has been rallying. Again, this is a lagger. The theme is to short the laggers throughout May. Stuff that just is falling behind, that's not making new highs with SPY, that is clearly relatively more weak than the overall markets. In this Square right here, it's going to be a tricky idea. You're just going to have to be patient. But basically, the short idea is at 71.25. If we do get back down to there, to short that thing. And I'm going to hold for my first target of being 68.35, and then below that, a new low or on momentum. Now to the upside, what is popping? Well, it's actually going to be healthcare names. These are going to be the names that I'm going to continue to long. They're slightly defensive, so they should be somewhat sheltered from the overall market BS that's going on. And specifically Moderna, J&J, biotech, XBI, these are going to all be decent names moving forward. Buy the dip trades, continuation trades, those are all going to be within these names. So for tomorrow specifically, I don't think I'm going to trade any of these, maybe Moderna if we gap up, but this goes through all the way next week. I want you guys to write this down, and tomorrow should probably be a boring Friday anyways. So make sure you prep for these. Specifically, I have calls in HUM right now, HUM, and I do expect continued upside for the 17th. If we look at the RG chart, the 60-minute used to have a defensive rotation, and I'll kind of show this to you right here. Boom. It was right on the May 7th. There was a defensive rotation. This was the initial sign that, hey, maybe there is going to be a drop. But it turns out that that defensive rotation just turned into a slowdown. And that's normal. When there's so much momentum in the markets, it is normal for it to not drop, but rather just slow down. That's exactly what we got. Now that we have this continuation, it seems the rotations are a little bit confused. So for the next few days, there's nothing much to show for, but on the 30-minute, if you actually look, there is a very clear growth rotation. This suggests that tomorrow, if we do not gap down that much, you should expect some sort of continuation, some sort of chop, maybe a slight decline, but the drop will likely not be as significant even if we do close underneath of that 5.7. And this is just a reminder that we cannot short the current momentum with big size yet. We can only take stabs at it in day trades. Now, looking at the market sentiment, the NAAIM number, this shows the market's firms' leverage. So firms in the market, how much leverage they're using in the market. Think about this as ammunition. The more that you use a big uptick, the more support they are giving the market. Now, we had the biggest uptick in the NAIM number in so long, and it was almost 30 plus points. It was from right here at 61.97 to all the way up to 91.55. This is very unusual. The last time this happened was at the beginning of the year around January. So we can expect, hey, unless if a news catalyst tumbles this tower down, to be happy with the longs, continue to trade the long side in small and mid cap names, but be very cautious of those shorts, continue to take the weaker names short, and to be ready for this big pump coming into the end. Looking at sentiment, the AAII Sentiment, we have a big downtick in the bearish side. Again, this kind of supports the idea that, hey, we can expect some bearish move to be likely if there is a news catalyst, but it's not very trader of us to be betting on a news catalyst. So for now, we must respect the momentum to the upside, especially with that NAAIM. The firm leverage is increasing. We have to continue to respect the upside trade as the momentum grows. And finally, the dollar and the VIX. Now, the dollar, we've been talking about the last few weeks, the correlation to the commodities that it's had. It's been moving parallel with them, but recently it's broke that relationship, and that's how they're supposed to move. Dollar is supposed to go up, commodity is supposed to go down, and vice versa. But that hadn't been the case recently. Now that the dollar went up enough to crack gold, send it back down, and now that gold's starting to bounce and the dollar isn't, they've restored that connection and relationship once more. So this is a good sign for the bulls in the sense that we do see commodities rallying. Gold had a mega day today, almost nearly 2%. And so we can expect, if that strength continues in commodities, we will see the dollar start to tumble even. Now, taking a look at the VIX, this thing has been getting slaughtered. But remember that this is just a reflection of option premiums. Obviously, as we rally, these will go down. Now, with the future of it, is it going to spike? That's just going to be pure speculation. But when it does spike, what we can expect is that we will not be playing the indices anymore. I will stick to IWM for the better alongside trade. However, plain SPY, QQQ, all these index trades will be too expensive. We must stick with the individual names or the derivative ETFs such as SPXL, UPRO, or SPXS, one of those guys. Those offer cheaper exposure when the markets get expensive premiums. Remember, the biggest fight with the VIX and traders is when the VIX does spike, you guys have to change your game plan. You have to find a way to trade the markets in a cheaper fashion, as well as one that you can take equal risk with. If you can do that, you will do very well compared to other people paying $400 for next day contract. And finally, our quote of the day: if not us, then who? And if not now, then when? This is John Lewis's quote. This hits me hard, and I used to be in a place where I had tomorrow syndrome, is what I called it, where I wanted to put everything off till tomorrow. When I didn't do something that day, I'd say, I'll do it tomorrow. And guess what? I never did it tomorrow. This quote is so impactful because if you do start to do things now, there's no greater influence than a habit. And I truly believe if you guys want to achieve your goals in trading, if you want to be a good investor, you have to learn now. Stop putting it off till you get a better job. Stop learning it until you have more time in your day, because that never comes. You have to fit it in now. That is when you'll see results. Anyway, guys, happy trading. See y'all next week. Bye-bye.